Hello everyone. So today I have a great guest, a long time a friend of mine, my mentor, my teacher, to be honest, Mark Daly. He is a regional sales director for Midwestern Canada, for Alberta, Saskatchewan and Manitoba, and represents Canada Life, Great West Life and London Life.
That's correct.
And thank you very much for being
Thank you, Andrey.
Yes.
Thank you.
So today I would like to ask you a few questions, and I really hope we will get great answers. I have no doubt on that, because lately what I have noticed, there is a lot of confusion with newcomers that I work with from Russia or Eastern Europe or South America about how much insurance do they have to have, what is mortgage insurance, what is the difference with life insurance, and how it totally work. Because lately what I've seen, and you probably have seen it much more, because you've been in the business for 28 years.
That's correct.
Yeah, well, so that's a lot of years to put in. And the question is, if you can tell us a little bit, what are the rules, like what people should look for when they're looking for a good insurance broker? What that insurance broker have to ask? What do they have to ask? How are those first couple steps? Like how much insurance do they need in the beginning? Because that is another confusion. Many people are getting like kind of mortgage insurance for the amount, like they bought a house like $350,000, and they think that's it, what they need. So here we go.
Andrey, it's a good question. What we're finding in the marketplace and what I've learned over the 28 years is that number one is you should have the right amount of insurance.
Yes.
Number two, it should be the right kind. And number three, it should fit within your budget or be the right price.
Yes.
Okay? Far too often you'll find an advisor or a broker that looks to fit with the right price and works it backwards from there. Unfortunately, that doesn't always solve the need. And as you and I have talked about many times in the past, I've never had a spouse or a beneficiary say, oh, he wasn't worth it, take some of the money back. I have received calls in the marketplace when a spouse, a survivor, calls and says, is that all there is? I was expecting more. And that's an unfortunate position to be in, because I have to look back and find out what the advisor proposed, what the advisor was kind of thinking when they proposed that kind of insurance, and the amount of insurance. So back to your question, what should the client be looking for in an advisor? They should be looking for an advisor that cares to listen to what their needs are. And their needs are covering debt, maintaining a lifestyle, putting kids through college, making sure that the debts are paid and taken care of, and that there's an income there to the survivor to supplement the income that they're losing.
Right.
So what does that mean? That means that the client should be looking to an advisor to provide what's called a needs analysis. And it is a document that's either on paper or on computer format that allows them to go through a step-by-step process to uncover what the need is. Mm-hmm. Far too often we'll find that somebody says, oh, if your mortgage is for $350,000, to use your example, we should cover off the mortgage because that is your biggest debt and we don't have to worry about anything else. There is so much more to cover than just the mortgage insurance. There's the mortgage insurance, there's the vehicles, there's the debt that they've accumulated on their credit cards, there's the debt that they're carrying at the bank, there's the student loans that they're covering. All of those types of things all compile into the debt. Mm-hmm. Then the next is, how do I maintain an income? Because if my spouse is at home, stay-at-home working mom, mm-hmm. Where's the income going to come from? Does she now have to sell the house and go find a menial task job mm-hmm. in order to feed the kids? So there's much more than just covering off the mortgage. There is so much more. So that needs analysis that comes in a paper format or a PDF format on the computer is absolutely critical to every advisor and client to be going through to assess what is the right amount of insurance. And today more and more insurance companies, reputable insurance companies, are asking for that needs analysis to be completed.
Yeah, it's a must, basically.
It's a must, because we need to know that you, as the advisor, have done the right job for your client to making sure and assessing that they have the right amount, the right kind, for the right price.
Yes. Thank you very much. Yes, that's very interesting. And what I wanted to emphasize, what you just said, that there's not only the debt coverage kind of
No.
but there's also a lifestyle coverage, because like it's kind of a joke, but it's not. If the husband has passed away and there's not enough insurance, the wife, in this example, would have to sell the house or get remarried or looking for some other partner, because there are so many things. Like she has to get enough money to save for her retirement, to put kids through education, to help them to get married, there's weddings and etc., etc. So this is very important, I think, and you just mentioned it.
There's another misnomer or a myth in the marketplace, is that we only need to insure the husband because he's the one making the money or the most amount of money. Unfortunately, that's not the case. If you take the example of the husband is working outside the home and the mom is a stay-at-home working mother with keeping the children in school and taking care of the home, what if we lost the mother? What's the value placed on the mother? Far too often we only insure the husband for the large amount of income that he's bringing home. And we neglect to insure the fact that the mother plays a key role and should actually be insured probably for even more. Because if we lost mom in that scenario, right, what does Papa have to do? He has to find a maid. He has to find somebody to look after the children. He has to find a nanny. And I know firsthand what a nanny costs. Okay? I'm a single father with a beautiful daughter at home, and I know exactly what a nanny costs. And it's anywhere between $30,000 and $50,000 a year.
Wow.
For a nanny. So where is that money going to come from? Does Papa now have to quit his job and stay home?
Yes.
Does Papa have to ship the kids off to different friends and family to help out?
Yes.
What does he have to do? If he's got to be at work for 7 o'clock and the kids don't go to school till 9, what do they do in that period of time? And they're little ones.
Yes.
So those things all need to be considered when doing a needs assessment, is what does the family really need in the event of a premature death of the husband or a premature death of the mom.
Right. And I would like you to just mention what you have mentioned to me years ago. What is basically the rule of thumb? How much life insurance a person needs to have? Because it just shocked me at the beginning when I heard it first time.
That's a good question. And I've been challenged on that many, many times from many actuaries and insurance companies. Does that rule of thumb really work? And yes, it does. So in the absence of having a needs analysis to complete, which can take some time, anywhere between 45 minutes and a proper hour. So if I'm in the elevator and you were to ask me, going to the 15th floor, Mark Daly, how much insurance should I have? My answer is anywhere between 15 and 20 times your annual income.
Wow.
So if you're making $30,000 a year, at minimum, you should have approximately $600,000 of life insurance.
Yes.
And that covers off, that'll take care of your mortgage. That'll take care of your debt on average. And that'll take care of supplying an income for your spouse, either way, to ensure that the children are well looked after, that there is a college education, that there is a retirement fund. Because let's face it, while the husband is still working or the mom is still working, the both of you are contributing to a retirement fund. But should one of you die prematurely, that retirement fund is cut in half or removed altogether if there's only one working person in the home. So that insurance provides a retirement income for the surviving spouse. So 15 to 20 times your annual income is the answer, and we're now on the 15th floor.
Right. Thank you.
You're welcome.
So we're not talking just to cover the mortgage cost or anything like this. Right?
No.
You mentioned as well, that's the right amount and then the right type of insurance. Just a little bit later, I would ask Mark Daly to show his famous presentation on the kind of insurance. But I want to ask you just another question, because not many of my clients, or I believe people outside there, have heard about those joint life insurance. There's joint first to die, joint last to die, combined insurance that allow our clients to maybe a little bit save on the cost of the insurance, as well as combining that life
Yes, Andrey, there's many types of insurance in the marketplace. You can have your own personal life insurance policy. Your wife can have their own individual policies. Your children can have their own individual policies. Absolutely. But there's another way that you can maybe save in terms of grouping everyone together on one plan. Mm-hmm. So that both you and your wife are covered for insurance, that if you died first, the policy would be paid out to your wife. Mm-hmm. If your wife died first, it would be paid out to you. If you lost either one of your children, then the policy would be paid out to both you and your wife.
Yes.
Okay? And I want to talk about children's insurance for a moment, if I may.
Sure.
Many people are afraid of putting insurance on their children. And I find that more so for an older generation or people that are coming over to Canada. It's almost like it's a bad omen to have insurance on their children.
Yes.
Okay?
We're afraid to even talk about it.
Absolutely. And I've got 4 beautiful children, ranging from age 37 to age 13. Don't ask. It's another story. But at the same time, all of my children have insurance, and they've had insurance since they were little ones. And the reason being is that, God forbid if I lost either one of my children, I would not be able to go back to work tomorrow. I would not be able to stand up and go back in and do my job. Yes. I would need at least a year off to get my head straight, to take care of the expenses, to take care of making sure that there's a proper arrangement made for my children, and to take time off of work as to what I want to do. The grieving process is different for everyone.
Yes.
And that insurance is in place, 1, in the event of an accident, a premature death of one of my children. 2, it guarantees their insurability, because when I bought it when they were little, I guaranteed their health at that age because they were young, vibrant, playing soccer kids.
Yes.
As we get older, we wind up with illnesses that we may not be insurable for.
That's right. And there's so many lately, like the cancer is giving, and you know better than anybody else.
Absolutely.
Like it goes all around, and I believe just recently that I would like you to mention about kids' critical illness insurance, but what recently I've heard, if before, like 10 years ago, we were talking about every 3rd person would get kind of a critical illness, today insurance companies are saying every 2nd.
Andrey, I am a cancer survivor, and I know that you know that. And it was only a year and a half ago that I was going through chemotherapy and battling cancer. And I was given 3 weeks to live and a less than 3% chance of making it through. Now, I'm a statistic that beat cancer, and I'm proud to say that I had an amazing team of people around me, but I owned critical illness. And the beautiful thing behind it is I believed in it, that I had critical illness insurance on all of my kids that I purchased right after they were born. Mm-hmm. Right? If I were to go and buy critical illness insurance for my children today, they couldn't get it because I had cancer. Now, I've already had it in place. It can't be canceled. The insurance companies can't come back and take it away.
No.
It's already in place. So if any of my children wind up with a critical illness, they're already covered. And again, the beautiful part behind it is not so that I get a payout, but it allows me to make sure that they have the most urgent care that's available in Canada or the US, because it's a tax-free amount of money that's paid out for these kids or myself in that position. Mm-hmm. And for the statistics, my policy paid out 243%.
Yes.
Okay? 243%. There is nothing that will pay
no
out 240. Nothing. So with the amount of premiums that I paid, the return of premium that I got, the cash back that I got, and the policy that paid out was 243% on my critical illness policy. So absolutely important, because I know for a fact that if my soon-to-be 13-year-old daughter got sick, I wouldn't be going back to work tomorrow. I'd be by her side.
Yes, absolutely. Yeah.
And that's why it's important.
And I have a few clients that had to go through this, and some of them didn't have insurance, like I wasn't in business at that time, right. and that is a struggle. That is a struggle. And the beauty of this critical illness coverages are that there's a rider, return on premiums. So if the person doesn't get sick, like you get all your money back. So it's kind of no risk, no brainer.
For us in the business, yourself and mine, it's the most selfless product that we can sell and the most selfless product that we can own. I used to have an idea that it was the most selfish product because if you needed it, great, and if you didn't, you got all your money back. So it was a selfish product.
Yeah.
But having my sister there to take care of me, it was the most selfless product because I bought it really for her. Because she was able to take 2 months off work. She was able to be there by my side, take over care and control of my daughter, make sure that all the bills were paid, my bills were paid. And the beautiful part about it was that when she called the bank to say, look, Mark is sick and I'm taking over and I have power of attorney, the bank said, oh, we're so sorry to hear that. We're so sorry to hear that. If there's anything we can do, please let us know. How's the mortgage payment going to be looked after?
Yes.
And you know what? My sister said, don't worry, it'll be looked after. And I had a critical illness policy that paid out, and the mortgage was paid. No problem whatsoever. And it was paid within 30 days.
Perfect.
Within 30 days of being diagnosed with a terminal illness. And you're quite right in your statistic. 1 out of 2 of us are going to get cancer. 1 out of 2. So you sitting here, my friend, and me sitting here, I was the one that got it. Right?
Well, but there's next one to me.
Exactly.
Who knows who is going to have that?
Absolutely. So very, very important that it should become part of your overall portfolio as a client working with your advisor to talk not only about life insurance in the proper kind, the proper amount, and the proper price, but critical illness and or disability insurance should also be part of that discussion as well.
A portfolio of insurance.
Absolutely, a portfolio. And it doesn't have to all be done today, but it's a regular follow-up that it's something that we're going to be working on together as we get to know each other as advisor and client.
And it leads me us to my second question. Let's pretend like, and probably all my clients right now are wondering, okay, we had established that we need $1 million insurance or $700 insurance, but it probably would cost me, like, as some of my colleagues providing, like, and pushing like 25, 30 years term insurance on that amount. What if it's cost forbidden? Like, they can't afford that kind of insurance. Should they lower the benefit amount, or where should they go and how to check?
It's a good question. Again, if you're not satisfied with the answer that you've been given by your advisor, look for another advisor. Absolutely. Do you walk into a car dealership and buy the first car that's presented to you?
Definitely not.
Oh, I do. Okay, maybe not. But at the same time, there is a process to follow. And we talked about it early on in this interview. It's about doing a needs analysis. So yes, if you present to me that I need $1 million of coverage to take care of my mortgage, my debts, my responsibilities, my family, my spouse, and my children, the $1 million is what we should be looking at. And we should not be jeopardizing that $1 million.
Okay.
Because that's not going away. So what we need to look at is the type of plan that will fit within the budget to get to the $1 million. And that's where most advisors miss that opportunity, is that they say, oh, well, you can't afford the $1 million? You know what? No problem. Let's cut it down to $500,000. Let's cut it down to $350,000. Let's just cover the mortgage.
Yes.
And again,
exactly.
now we've missed the opportunity. We started out, what's the first thing? Right amount.
Yes.
Second one is right kind. Third is fitting in with the right price.
Right. And that leads to the third question, and I would ask you, please show us, like, what is the right kind, like what kind of insurance, life insurance we have there, and how, like you taught me, and I would like you to do this presentation, how to go around, like, the kind of insurance and the right budget, how to put it together.
Absolutely.
All right.
I'd be more than happy to do so.
Thank you.
Can I use your whiteboard?
Absolutely, yes.
Thank you. Andrey, we have 3 types of life insurance in the marketplace today, and it's all called various amounts of names. And insurance companies will tell you that they have 20 products on the shelf, etc. Absolutely. But when we break it down, there's really only 3 types of insurance. And the first one is what's called term insurance. And there is term 10, term 15, term 20, term 25, and sometimes even a term 30, depending on which insurance company you're dealing with. And I'm not promoting one insurance company over the other. Everyone has a variation of these types of term coverages, and they all fit in a very specific manner in a very specific place. And here's how it works. It starts out cheap and cheerful. Okay? Kind of like cheap cheap boxed wine, all right? And here's the term. It's term 10. And at the end of 10 years, we're now up to 20 years, the price goes up. And then the price goes up again at 30 years and again at 40 years, right?
Yes.
It gets cost prohibitive in order for us to continue to work with it. But here's how it works. Somewhere between the ages of 65 and 80, depending on which insurance company you're dealing with, the insurance company says, Andrey, thanks for coming out, but we now have to cancel your insurance because we can't insure you beyond that age. And all of the money that you've put in here is gone. Is it a bad type of policy? Absolutely not. But it's designed with a specific reason and a specific time period in order to cover off debt. A 10-year loan, okay? A 30-year mortgage. But is it really the best insurance for a 30-year mortgage? I don't know. That's why the needs analysis is so important. And I'll keep referring back to that from time to time. So, is it a bad plan? Absolutely not. But it's designed for a very specific reason. So let's go back to your example of $1 million of coverage. And I need it for my mortgage, and I need it for debts, etc. But I can't afford it. Well, instead of doing a 30-year term that I can't afford, why not go with 10-year term? Something that I can afford for right now. Because probably in most scenarios, you're going to get pay increases, you're going to remove debt, you're going to make changes in your family where you're going to have disposable income increasing, not decreasing. So the disposable income that you're going to have, the money available over the next 10-year period, is going to allow us to revisit this at least every 2 years. And your advisor should be meeting with you a minimum of every 2 years to review this plan to see where we're on track. Does that make sense?
Absolutely.
Great. Here's how mortgage insurance works with the banks. Okay? It works actually in reverse. What they do is they say, no problem, we're going to insure you for your $350,000 of mortgage. Typically, they'll ask you 4 to 5 questions on the application. The underwriting is usually, depending on the insurance company or the bank, the underwriting is usually done at time of death. So they'll check to see whether I had cancer or not. Oh, we probably wouldn't have underwritten him. So the insurance is null and void. It's not paid out. So if I had a wife at home, she'd be waiting for the mortgage to be paid off, but it's not. And as the mortgage decreases, the price increases because I'm getting older, right? So the price increases and the amount of insurance decreases. The bank is the number one beneficiary. My spouse never even gets to see the money. So if I have a mortgage of $350,000 with interest, that gets paid out, nothing more. There is no money for my burial. There is no money for my wife to pay the bills for the next month. It's done. So I always talk to my clients, your clients alike, that if there is an option to review the mortgage insurance that you have with your financial institution, chances are my price is going to be better, my product is going to be better, we're going to get you the right amount, the right kind for the right price. Now, Andrey, there's a second type of insurance, and it's called term to 100. In our marketplace, we even have what's called term to 85. So, much the same as this, except $85 or $100, the price is a little bit more. We usually use it in business situations. So you and I are in a business relationship, we own a company together, and we have a buy-sell arrangement between the two of us. Or I have a spouse, you have a spouse, and you know exactly what your tax bill is going to be. You know that your tax bill and your expenses are never going to change, and you need $1 million of coverage. You know that you're never going to need any more, and you know exactly what you want to spend on it. And this, if you recall, we had term insurance here, right? That was a little less expensive. Well, your term to 100 is a lot more expensive. but you know exactly the fixed amount and you know exactly the fixed price. Okay? Business relationships, marriages, a joint first to die type of relationship, then that's where you would use that product. Usually we use that in products or demographics of ages 45 to 65. Okay? Not usually in the younger marketplace. And the last one is called permanent insurance. You and I refer to it as universal life or participating whole life insurance. PAR is short for participating whole life, and UL is short for universal life. And here's the way it works. This is your price line, and we either call it a deposit or a premium. Premium when you're just paying the bare minimum for cost of insurance. Deposit allows you to overfund it or put more money into it and use it like a tax-free savings account. Because the money grows tax-deferred compounded each and every year in there. And I always say it twice, tax-deferred compounded each and every year. Why? Because it sounds like an RRSP, except you don't get the tax deduction. Okay? So I can have money growing in here tax-free each and every year. I can't do that at my bank.
Nope.
Unless it's a TFSA, right? So it's a deposit or a premium. And this here is a cash line. The cash is not mine. It's not the insurance company's. It's not your advisor. It's yours. As the client, this cash grows tax-deferred compounded each and every year. The money is yours to use. I often say, please don't think of it as a savings account to buy a new TV. Think of it as a savings account to pay down your debt, to put your children through education, to have as a supplement to paying down your mortgage later on in life, or to using it as a down payment for your children's first home. Okay? Somewhere between year 10 and year 20, depending on how you and your advisor structure it, you can have this policy paid up or paid for, no longer requiring any premiums in this policy. And you can have it until death. 102, we'll pay it out. 105, we'll pay it out. Okay? Is it a little bit more costly than your term insurance that we started out with here? Yes. Is it a little bit more costly than your term to 100? Yes. But is it the Cadillac of all plans? Absolutely. It allows you the opportunity to pay for your insurance and have it for the rest of your life. It allows you to have tax-free growth inside your plan. And it allows you to have access to that cash if and when you need it. And there's a number of different ways that you can access this cash. And between working with your advisor, you can find out how to access this money on what we call a tax deferred basis, or sometimes, depending on how it's structured, even tax-free. So the importance of having a plan like this is extremely important. The idea behind having something that you own, it's like a piece of property. It's like your own home. So do you rent term insurance, or do you own permanent insurance like universal life or participating whole life? That's a decision you have to make in working with your advisor, right? And doing that needs assessment, I mentioned that I go all the way back to it.
Right.
The needs analysis is so critically important, determining how much I need. Now, if I can wrap this all up in one easy presentation, Andrey, please allow me to do so as to why this is so important.
Absolutely.
We talked about the value of the amount of insurance. My elevator pitch at 15 to 20 times your annual income. So let's use that example of somebody earning $30,000 a year. Does that make sense?
Yes.
Okay. So if I'm making $30,000 a year times 20, that should be $600,000 of insurance. Most of your clients and my clients say the same thing. That's a lot of money for somebody making $30,000 a year. Married with 2 kids at home? Really? That's a lot of money. Yes. Now, Andrey, what's the average mortgage that you're putting through today?
300,000.
300,000? So the mortgage is 300,000. That leaves $300,000 of money. Wow, that's a lot of money. And it's tax-free because the insurance companies don't tax you, right? So on that $300,000, the average Canadian is carrying about $70,000 of uninsured debt. Uninsured, not unsecured, that's different. Uninsured debt. Credit cards, credit lines, checkbook balances, etc. So what if we said $50,000? That leaves $250,000 left for me to spend. What we're finding is the average Canadian also owes extra to mom and dad, a grandpa and a grandma, somebody that helped them out with their first home, etc. Okay? And what if we said that was $25,000? That if they could pay it off, they would. That leaves them $225,000. The average cost of a funeral, last expenses. I go first, okay? My kids know to sharpen my ankles and drive me in the ground, we're good. However, the average cost of a funeral is around $25,000. That leaves $200,000. Everything is now paid for, and I have $200,000 to put in the bank. $200,000 in the bank at a fair interest rate today, and it's still amazing that I still do this presentation with people, and I'll stop and ask them, what do you think a fair interest rate in the bank would be today? And there are still people that answer 10%. 5% is aggressive today. Okay? But let's say we could get 5%. If we could walk into the bank and get 5% on my money. At 5%, that equals what? $10,000 per year. After tax is, let's say, about $8,000 per year. There was $30,000 coming into the home. This leaves me $8,000 per year, not touching the principal of $200,000, because that $200,000 I'm going to use for children's education. I'm going to use for buying a new car. I'm going to use for upgrading the house, putting a new roof on, etc. So I'm still going to get somewhere between $8,000 and $10,000 a year coming in. I'm still going to have to go back to work. I'm still going to have to do something else, but at least I have a little bit of a cushion to allow me the time to re-educate myself, to go back to work, to grieve with my kids, and take the time that I need after losing a significant loved one. So, is $600,000 a lot of money?
Not at all.
It's just enough. We're not in the business of creating a lifestyle for somebody that isn't already there. We're in the business of protecting the lifestyle that is there.
Great. Thank you very much. And one more question that comes. Can we combine like those different kind of insurance? Can we combine universal life with term? Can we mix and match?
That's the term. That's the term to 100. This is the term. And this is the permanent insurance. And your question is, can we combine any of those? Yes, you can combine them all. And so you should. My portfolio at home for my personal family situation has a lot of term insurance in it. I also have a lot of permanent insurance. And it's universal life and whole life. Because I see the whole life as an asset in my portfolio. I see the universal life as something that I can deposit, withdraw, change, and modify on a daily basis if I need to.
Great. Thank you very much.
Thank you, Andrey.
All right, well, thank you very much for the great presentation, and it's exactly what I've seen about 10 years ago, and it's still working. That's the way. And I would like to remind my clients and guests that we're talking today to a professional with 28 years of experience in insurance products and financial services products, Mark Daly. Thank you very much again, and I hope to see you again, and good luck to you.
Be well. Thank you, Andrey.